Welcome to Pro Webcast News, where we bring you daily industry updates. Today is Tuesday, September 8th, and you're watching the Afternoon Update with Paul Wilson. Today's news is sponsored by Sunderland Group, your success, our tradition. For more information, please visit www.sunderlandgroup.com. Now for today's headlines. A key indicator of the strength of the job market in the U.S. dipped in August, indicating that the employment market will likely remain flat through 2009, according to the Conference Board. The board's Employment Trends Index declined to 88.1 in August from a revised 88.2 the previous month, leaving it 18.5% below its reading from 1 year ago. According to Gad Levinan, economist at the Conference Board, quote, "The flatness of the Employment Trends Index in recent months suggests that we won't see job growth until the end of the year. The fact that the index cannot get off the ground is another sign of a weak recovery, perhaps a jobless one," unquote. Meanwhile, a government report last week showed job losses declined to their lowest level in a year last month, while the unemployment rate climbed to a 26-year high. In economic news, small business sentiment in the U.S. climbed last month as optimism continues to grow that the recession is ended. According to the National Federation of Independent Business, or NFIB, its optimism index climbed 2.1 points to 88.6 during August, led by improved expectations for future business and real sales volume. The reading is 7.6 points above March's level, which was the second lowest reading since the index began in the early 1970s. According to NFIB chief economist William Dunkelberg, quote, "The gain in the optimism index clearly signals that the worst is likely over, but so far there has been no surge in sentiment or in the important index components directly tied to gross domestic product," unquote. The survey revealed that employment is still hard to find, with average employment per small firm declining by 0.8 workers during the previous 3 months, which was a decline from historical averages but a huge improvement from a decline of 1.26 workers seen in May 2009. In insurance and P&C news, certain state-run residual market property insurance plans are facing financial struggles, according to a recent white paper by the Insurance Institute. Titled, "Residual Market Property Plans, From Markets of Last Resort to Markets of First Choice," the paper states that state-run insurers are facing greater risk due to dependence on bond markets. Disruptions in credit markets are expected to increase the difficulty and expenses of issuing debt to pay for hurricane losses for some plans. Meanwhile, the paper says that some state legislation will expand the exposure of the plans while reducing rates, which could reduce state finances and lead to increased assessments for taxpayers and policyholders in the future. In addition, the study found that the size and exposure of state plans have increased recently, with total policies in force in the plans climbing to more than 2.6 million in 2008 from less than 1 million in 1990. Finally, total loss exposures in the plans climbed to $696.4 billion in 2008 from $54.7 billion in 1990. I'm Paul Wilson, and thanks for watching Pro Webcast News. For more in-depth news and features, visit producersweb.com.